Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
As I said earlier, when you look at these correlations, try and ask yourself, is it logical? Does it make sense? Is there some economic relationship back there? I talked about gold. That one makes sense. It's a logical relationship. If you're looking at something, sunspots and S&P 500, the correlation may be there, but it may often be tough to find some type of logical relationship. I'm not saying there isn't one between sunspots and S&P. I know there's a lot of things out there in the world we don't understand that can be used. We actually happen to still watch the lunar cycle very, very closely. Again, we're not quite sure why the correlation exists, but we often see something that seems to be above coincident on full moon cycles. There you go, Steve. How you like that one?
Love it. Like the old AFL NFL, right?
We don't go that far. And the payoff for us and how we use this stuff is especially good in options trading, we think, and very good for the options on ISE is because we prefer the options in the longer term time frame. Longer term, we see, several month time frames, and we think this intermarket correlation really pays off more in those longer term time frames. Weeks to months is really what we think is the most benefit we gather out of this. We do use it, as I said, in shorter term time frames, but often, as you know, if you've traded in markets, you can get a lot of noise intraday that's irrelevant and doesn't maintain an economic relationship, so you have to be careful there. That's why if you step back using daily and weekly charts, we think you're going to find these correlations a little tighter and make a little more sense than you do sometimes breaking down the hourly charts or even 30-minute charts. But we do look at them there sometimes and see some important stuff, especially when you look at the S&P. The S&P have been trading very, very tight with things like the euro and those types of things in the past. Again, that's breaking down a bit lately, so you have to be careful. So, can support the short-term trading decisions. One of the ways we also use these things is if we see a correlation, and I'll show you an example of this. If we see a correlation that's been very, very tight, and there's no reason particular that we can think of why it's changing, and all of a sudden there's a big divergence in that correlation. And the one I'm going to show you is Australian dollar versus the CRB, the commodities index. That kind of led us to thinking about other stuff, and that's when you have to start thinking about this stuff and then look at your other correlations and then look at your other technical analysis and say, is there a setup here? And that's the logic I'm going to take you through here in the next several charts. Before I get to the charts, real quick, what do we look at? This is what we look at every day. Of course, the major currencies. Sometimes we'll look at the emerging market currencies because we do trade those, but the U.S. dollar index is the one we use most often. It's kind of a thumbnail temperature gauge. We look at the S&P 500, the Japanese Nikkei 225 index, and we look at the Shanghai. Shanghai, increasingly important. That's the Chinese stock market. We look at, on the fixed income side, we look at 10-year notes, U.S. 10-year Treasury note futures. We look at the T-year note futures, and we look at German bonds. German bonds, really that's the power game in Europe in terms of safety and quality for the bond side of the fence. We look at Fed funds and we look at LIBOR. LIBOR is London Interbank Offer Rate. These two together are important. It gets a little esoteric when you get sometimes into this money market stuff. I won't get into that, but we look at those for a reason to see to help us make a decision on, tightness or some dislocations on the front end in the money market and the interbank market. But we look at that, and we look at gold very closely, and we look at oil. And they've been very, very tight in the last several years in that move. As I said, the last bear market move in the dollar. Okay, let's get started on some of the things that we've done. And as I said, I'm going to take you through kind of some trade setups that we saw breaking out recently that we caught here in the euro and been very, very happy. We caught them in some of the other currencies too, just based on this, and then give you some of the thinking. We wrote a report back in June of last year saying that there's really a chance of a breakup of the European monetary system. Got a couple chuckles from people, obviously, but it was about a 20-page report, a lot of research that we put into it. The bottom line is the euro really is an artificial construct. We've always believed that. We never thought it would be a challenge to the U.S. dollar. It doesn't fit the bill as a world reserve currency. It doesn't even fit the bill as a common currency itself because of a lot of really just pure economic reasons, unsynchronized business cycles, different labor productivity across the various countries. You have political squabbling, and you still have massive sovereignty in the individual countries. It is not the background for a common currency. Milton Friedman talked about this years before they were going to form the euro. A guy named Mundell pushed this whole idea, an economist in the U.S. Friedman poo-pooed it and said sooner or later it'll break apart. We're definitely on the Friedman page. So we did a lot of economic analysis on this and wrote that piece. And a lot of the stuff is starting to come to fruition. We always believed that the first time we had a major test of the euro since its introduction, which we haven't had until the credit crunch, we would see where the rubber meets the road, and it's starting to meet the road in a big way, and it's in big trouble. And I think at the very least, I think people are realizing that this is not a currency that will challenge the U.S. dollar in terms of world reserve currency status. It'll be lucky to stay together, given what's going on. We've been watching this spread for a while. We told you we looked at German bonds, and what this first chart is up here up top is a spread between the German government bonds, the 10-year Bund it's called, and the spread between the Greek bonds, Greek 10-year bond spread. Okay? And as this goes down, it means the spread is widening. It means the interest rates for the Greek bonds are increasing relative to Germany. If you look at this system up in here, and actually if you go back even further, this is only October 2009. Greece only had to pay 130 basis points or 1.3% more than Germany, even though they were a fiscal basket case and everybody knew they were. If you go back even further, the difference between German bonds and Greek bonds was probably about 20 basis points or less at times when the euro was first created. That's why the euro was created, so to speak. So these countries like Greece and Portugal, the pig countries, Portugal, Italy, Greece, Spain, could borrow at German interest rates. Now, right out of the box, you know that's an artificial construct for them to be able to borrow at German interest rates. But it went on for many, many years. The goal was to allow them to get enough revenue and income in order to bring their economies up to speed, start to build labor productivity in line with Germany. It never happened. They continued to spend like drunken sailors, which, of course, the U.S. has been doing a very good job of that lately, too. But at least we have a better economy, so to speak. These guys didn't. So all of a sudden we come to this first major test in the euro because of the credit crunch, and the market finally starts pricing in risk. I don't have back here during the credit crunch, but we saw a big move down in the spreads during the credit crunch, too, and they recovered. But lately now, because of the specific Greece problem, the Greek bonds, the spread's starting to widen. So the bottom chart here is a picture of the euro versus the U.S. dollar, okay? And again, we're looking at this correlation. You notice something here. As soon as this started breaking back in November down, meaning the spread widened, what did the euro do? The euro started to take that hit right in December. When did it start improving? Right here, December 21st. When did the euro start to rally? December 22nd. Pretty tight correlation. What is interesting also is gold actually moved in this exact same pattern. Gold broke down on this risk with the euro. Gold did not play its role as a safe haven, which tells us there's a liquidity game going on here again. That's a whole other thing we put in our pocket to think about, and I'll explain that going forward.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.